You talked about the smartest, wealthiest people you know got rich and stayed rich with a simple strategy. You're big in simplicity. You're thinking complex, but you simplify it, which I admire. And you're very articulate, which I think helps people's understanding and adoption of Bitcoin. You talk about you create or buy assets that have high quality, pristine assets that you collect and you hold them forever. When you need cash, you live. Obviously, you finance them and borrow against them if you need cash to live. You don't think there's really ever a reason to sell your Bitcoin because you could borrow against it. You actually stated that you feel like it's stupid at some point. Can you explain that strategy? Because that, once again, totally shifted my thinking. And there's a lot of people that do value and want to get wealthy and create generational wealth for their family and really make a difference. So that strategy is not normal. It's not talked about. You don't learn that. I went to business school at U of O, College Lundquist of Business. I did not learn anything about that. So share that strategy of borrowing against the assets.
Okay, so the strategy is levered long property, leveraged property. Okay, so let's illustrate with a simple idea. You're from a family in New York City, the year's 1972. You have $1 million. What do? You buy property in New York City because New York City is scarce, desirable property. You can buy $1 million of property and the Federal Reserve keeps printing 10% more money a year. If you have $1 million of property and there's 10% more money a year and it's scarce, then logic says the property is going to go up in price 10% a year. Now here's a better idea. You actually buy $10 million of property and you put up $1 million as your deposit, and now you have 10 million in assets and you borrow $9 billion. And you pay 3, 4, 5, 6% interest. As long as the interest rate is lower than the rate of monetary inflation, if the money supply is going up at 10% a year and your loan is 5% or 3%, then that works. At some point, right, you can imagine you want to make a lot of money. You borrow 900 million, you post 100 million in equity, you buy $1 billion property. The money supply expands by 10%. It's now worth 1.1 billion. Now you have 200 million in equity. You only put up 100 million. You got 100% ROI. If that runs 10 years in a row, you'll have $2.2 billion property value. You had $1 billion in debt. You've got accumulated interest, right? If the interest rates are really low, when the interest rate's very low, this strategy works even better, right? If the interest rate was 10 or 20%, the strategy doesn't work as well because you're getting hit with high interest charges. But if interest rate is low, you might very well find yourself with $2.2 billion of property, $1.4 billion of debt with accumulated interest. Now you've got $800 million of equity. Okay, now you want to live. Your family wants to fly and buy jets and yachts. What do? You refinance the property and you borrow $200 million against the property. Now, is that income? No, there's no income tax on it. Do you sell the property? No, there'd be a capital gains tax on it. How do you actually get the cash? You just borrow $200 million more. Instead of 1.4 billion in debt, you have 1.6 billion in debt. Now you spend your $200 million. And what do you hope for? You hope interest rates will stay low. And you hope that the Federal Reserve will keep printing more money. Because if they keep expanding the money supply, what happened to houses in the Hamptons this year? They went up by like 50%. What happened to houses everywhere in the country? If they're desirable houses, they went up 20%. So this levered long idea, it works for property. Now let's just apply it to digital property. Is there a difference? Not really. You have $1 million, take your $1 million and buy $1 million of Bitcoin. If I sell it, then if I sold the $1 million gain, I'd pay $400,000 in tax to the federal government and the state government. I'd have $600,000 in cash, and I'd only have $1 million of assets that are appreciating at whatever percent a year. If I don't sell it, I don't pay any tax. What if I just borrow $100,000 against the $2 million and I pay? Coinbase will give you a loan for 8% interest. I have credit lines where I can borrow against Bitcoin at 2.5%, 3% interest, right? If you have the right institutional bankers. So maybe you pay 5% interest, let's say. So you borrow 100 grand, you pay 5% interest, you owe $5,000 in interest a year. After a year, you'll owe $105,000. If Bitcoin's going up at the rate of 20% a year, you would make $200,000 by keeping it. If it goes, as long as the appreciation rate is greater than your expense ratio, you can borrow forever, right? Like the second year I borrow another $100,000. But now I've got, if Bitcoin's going up, put the number in again, 20%, you've got 1.2 million the second year, then you've got 1.5 million the third year, then you've got close to 2 million the fourth year. So you can work this out in your head, and what you realize is your rate of liabilities is growing slower than your rate of assets are growing. And when you crank in a number like 50%, what you realize is you're a fool to sell the asset. Yeah. Right? You want a Tesla, you don't pay for it in Bitcoin, you borrow money in dollars, you buy the Tesla, right? And then your Bitcoin appreciates and it doubles 3 more times. And pretty soon you've got like $20 million of Bitcoin and you owe $50,000 against the Tesla. And you got to pay 5% interest. So 5% interest times 5 years is like 25% more. So, okay, well, you owe $60,000 for the Tesla. You really want the US dollar to exist along with Bitcoin, because what you want to do is you want to put all your assets in Bitcoin, and then you want to draw credit lines in the local currency like dollar, and you want to pay all your living expenses and live in debt. And then you really want to die in debt. Like crank in a number 20, 30%, start with $1 million. You'll end up with $100 million in assets, $15 million in debt, and never paid a dime of tax your entire life. Now, all it takes, right? You need an asset that's going to appreciate. What will appreciate? Scarce, desirable assets. I'm not going to guarantee you that Saylor Moon coin will appreciate your entire life, right? It may not be scarce and desirable. You want the dominant digital property network. You want the New York City of cyberspace. But it's better than New York City, right? Because everybody can't live in New York City. Everybody can live in Bitcoinville, right? So you want the scarce, desirable asset. The second thing you want is a bit of monetary inflation. The third thing you want is low interest rate. The fourth thing you want is you want a bank that you trust. Luckily for you, there's a lot of competition and Bitcoin banks are coming online. There'll be more competition. Luckily for you, politicians are going to keep printing more money. Luckily for you, Bitcoin is scarce and desirable. So now you just got to understand the dynamic and you figure it out. If Bitcoin's going up 100% a year and it costs you 5% to borrow the money, borrow $1 million at 5%, loan it out to Bitcoin for 100%, scrape the 95% arbitrage, you make $950,000 a year off of $1 million loan, right? You make $95,000 a year off a $100,000 loan. If you got a house and you can mortgage the house and get $100,000 of mortgage and pay 2% interest or 2.5% interest to your bank, and you lend it to Bitcoin and Bitcoin pays you 25% interest, you're getting 22% tax-free yield. So find long-term loans at low rates, invest in something intelligent, and wait. By the way, this is the basic principle of all businesses everywhere. Raise capital as cheaply as you can and invest in a business that's growing, that is going to appreciate in value. And it could be the same idea would work for Amazon stock or Facebook stock or Apple stock or New York City real estate or Hamptons homes. It just comes down to what's the appreciation you expect, what's the carrying cost and the maintenance requirement, and can you get capital? If you can't get debt, get equity. If you can't get equity, you get sweat equity, right? I mean, it's kind of that simple.